The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Welcome to the Accunet Mortgage and Realty Show, getting you inside information on buying, selling, and financing your home with expert advice from Accunet Mortgage and Realty's Brian Wickard on WTMJ.
Well, pleasant Sunday morning, everyone, and welcome to the Accunet Mortgage and Realty Show. I'm Mark Seacrest, along with Accunet Mortgage and Accunet Realty Advisors, owner and president Brian Wickard, and senior vice president Jerry Serkatich. It's a pleasure to have you guys in the studio with us today. First, before we get going, I should remind folks, our listeners, that if you have a question or comment, you can reach us on the Accunet Mortgage Talk and text line. The number is 414-799-1620. Okay, you've got an interesting rundown on today's show. No, it's a shortened version, but it's a busy version.
Busy and short. All right, so let's get right to it. Mortgage rates are up, and not just by a little bit, but by quite a bit. They're the highest they've been since last March. The interest rate, by the way, that you and I are paying to borrow money is Uncle Sam on a 10-year Treasury note is at 2.82%, and that's the highest the 10-year Treasury yield has been since 2014. So we're kind of in a new world. At the close of business Friday, Jerry, where were we on a 30-year fixed at low overhead Accunet?
Yeah, we ended the week at 4.375. Still a very good rate, but it is up about a quarter point.
Sounds high to me.
Yeah, the APR on that was 4.405. And interestingly, when I was here a couple of weeks ago with you, Mark,
yes,
we were at 4.125. And interestingly, I think our listeners would be, we're going to talk a little bit about payment difference. The payment difference from a couple of weeks ago at 4.125 on that $200,000 loan versus today's 4.375, $29 per month on a 30-year fix. So you're putting it in perspective. Nobody likes to see that payment go higher, but still, I think in striking distance, people are still going to be able to buy a home that's not going to take them out of the affordability range. But the 20-year, let's just talk real quickly. 20-year was at 4.25. The gap between that 30 and 20 is still very slim. The 15-year fixed was up a bit. Still, though, starts with a 3, which we like. 3.875 with an APR of 3.923. All of these no points rates. Closing costs under $1,000, $950 in total costs to secure those options. The adjustable rate mortgages, Brian, not really worth talking about.
Only
yet.
If you're in a jumbo mortgage, which is currently over $453,100 in your jumbo. So I was kind of being hyperbolic by saying, it sounds high, because it does. 4.375 sounds high compared to what we were advertising at the beginning of January. 3.99% with no points on a 30-year fixed rate. But it's really not that big of a deal in terms of monthly payment. It's not going to stop too many people from buying a home.
Correct. Because like you said, when you hear that increase in rate, it sounds like, whoa.
Chest clutching.
But when you put it in perspective and look at actually what the payment differential is,
not too bad.
Yeah, correct.
All right, so let's talk about why this is happening. Let's remember why rates were low for so long. Because we had a financial crisis. And the economies around the world were doing horribly. So the central banks jumped in, lowered interest rates, short-term rates to 0, or in some cases in Europe, below 0, which is hard to fathom. Mm-hmm. And then they also started printing trillions and trillions of dollars of either dollars or euros, and they use it to buy long-term government debt, and also in the U.S. bought trillions of dollars of mortgages. This brought down mortgage rates significantly. Remember, we were at 3.375. I think we wrote some 3.25 30-year fixed rates for a brief period of time. But let's say, they were at 3.5 for a long time. All right, so now what do we have happening? Remember the old economics rule of supply and demand? Well, now we have the central banks doing the opposite of what they did before. The Federal Reserve is now a net seller. They are trying to reduce their $4 trillion portfolio of mortgages. Right. And so they are now a net seller. They're not buying anymore. That means that demand is down. At the same time, we've got the tax reform going on, which makes tax receipts every month less. So guess what the Treasury is already having to start to do? Issue more debt.
Right.
So supply is up. Demand is down, supply is up. So what has to happen to interest rates in order to attract more investors? Mm-hmm. Interest rates have to go up. On top of that, you got the stock market is doing, despite Friday, when we really took it in the knickers, going down over 600 points on the Dow Jones. That would normally, by the way, be good for interest rates, but not on Friday. The bond market gods are so mad right now, so kind of ornery, that interest rates continued to rise even as stock prices fell precipitously. That is abnormal, and I think is an indication of how mad the bond gods are.
Right, and we talked about it on Friday. Investors weren't buying anything. Normally
That's a
they're
good point.
Right.
They're selling everything.
Right. Normally they're going out of the equities and moving money into the safer investment of bonds. They weren't buying anything on Friday.
Now, and here's just another indication of somewhat of the irrationality of it all. Inflation is the enemy of interest rates. If I make you, Mark, a 30-year mortgage and I'm getting 4% interest and inflation returns to 4%, I am making zero. All right? So the higher inflation goes, the worse it is for rates. The latest inflation number we got, I think, last week, and this is the Fed's preferred measurement of inflation. It's called the Personal Consumption Expenditures Index. It only shows inflation at an annualized rate of 1.7. That's still below their 2% target. So that isn't bad, but the market is assuming that inflation it's just around the corner. And one reason is that wages were up year over year. In this past Friday's employment report, wages grew at 2.9% year over year.
Right. New jobs created were basically on target, but It was that payrolls number, the wages number, that I think the investors were watching closely. But to your point, too, well, I guess we're up against a break.
We're up against a break.
We'll pick
yeah. That's enough. Rates are up. They're not horrible. They're just higher than they were. All right, when we come back, Mark, we have a tie-in to real estate and the Super Bowl. We're going to get to that when we come back.
And you're listening to the Accunet Mortgage and Realty Show on 620 WTMJ.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickard on WTMJ.
And if you have a question or comment, our phone lines are open, 414-799-1620, or throughout the Midwest on the Accunet Mortgage toll-free line. That's 1-800-877-1620. This is a fascinating discussion this morning, Brian. It is.
So Jerry's got the story on the Super Bowl and real estate markets. Jerry, over to you, buddy.
Right. Let's. This is interesting. Found this at Realtor.com, and they actually are out with a Super Bowl winner prediction based on housing. And so they acknowledge that there's not any correlation, any real correlation between football and real estate.
All right, but nonetheless.
But they've made their pick based on the Boston and Philly housing markets. And they come here with, here's Nate Johnson, Chief Marketing Officer at Realtor.com, says, with strong home prices and fast days on market, there's no question that Boston currently has a more dynamic housing market, which in our minds makes it the clear pick for the upcoming game. He goes on to say here, in comparing these markets, it's interesting that Philadelphia and Boston had strong real estate seasons this year, generating first down payments. Get the old a
little play on words there. First down payments.
And new home turf for thousands of buyers. But Boston showed more potent price yardage overall, with listing prices driving up 8% year over year, compared with Philly's 6% gains.
Healthy in both cases, just by the way.
True. And then he goes on, Boston also showed a faster running game, with for sale inventory reaching the end zone in selling in 48 days versus 70 days in Philly. When it comes to inventory declines, Boston dominated, with inventory down 18% year over year compared to Philadelphia's 15% decline. So there you go. Realtor.com makes its pick here based on a comparison of listing prices, days on market, inventory in both markets, and here they come out with their prediction.
They're going with New England. All right, so here's a question for Mark. How much for a 30-second Super Bowl ad?
Well, I heard a figure of recently, $5 million.
$5 million. That's what I've read everywhere. Okay, guess who has a Super Bowl ad in this Super Bowl? Not Accunet Mortgage. Nope. Oh, I know. Quicken Loans, which is a registered trademark of Intuit used by permission. So Quicken Loans has a $5 million Super Bowl ad, and they're on all the college football games. They're on every weekend. They're on college basketball. They're on golf. All right, so if you take that $5 million and you divide it out over their next 5,000 customers, each of those customers only has to chip in an extra $1,000. Only, I say facetiously, to cover the cost of that one $5 million ad. So literally, folks, low overhead Accunet's closing costs are literally $3,000 to $4,000 less on a $200,000 loan than the guys from Quicken Loans.
You got, $5 million, 30 seconds. You got probably 24 seconds a copy. I know you write your copy a lot.
Yeah, I do. I write it all.
What kind of point can you expand on in 24 seconds as it relates to the mortgage and the economy?
Well, I've noticed that in their current ad campaign, they like to say that you can get your loan approved in as little as 8 minutes. Mm-hmm. And I'm curious, and I would love some regulator to make them fess up to this, what percentage of their online borrowers can they actually approve in 8 minutes? Because even if you and I know it's possible because our technology is getting better and better. You can get an automated credit report. If your employer is large, if you work at Pac Bell or Boeing, even we can get the your income information verified instantly. If you're willing to give your bank password to your mortgage lender, we can verify your bank account instantly. And so it is possible. But frankly, most people, we still think when you're borrowing $200,000, and this is either the first or second largest financial thing, maybe you just don't want to have it done by a computer, online. Maybe you want to talk to a licensed, one of our dozen handpicked, trained by Brian and Jerry loan consultants to help you through that and not just do the slapdash thing.
And even the 8-minute approval. I mean, it's a conditional approval.
Oh, yeah. You don't have the appraisal by that point. No, that's right. Okay. So when we come back, we do have some real stories from the front lines of mortgage lending talking about supply and demand. And this has to do with a buyer that we've talked about before, buying in suburban Chicago when we come back.
The Accunet Mortgage and Realty Show right here on 620 WTMJ.
Expert advice on buying a home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickard on WTMJ.
You've got some thoughts as it relates to supply and demand at this point, Brian, right?
Yeah, I'm going to give you the flash numbers, I'll call them, for southeastern Wisconsin, just to give you an idea. So this January, 847 single-family homes sold. That's 10 more than January of last year. The median sales price was $190,000. That's up from $189,000 last year, so only up 0.5%. Now, does that mean that home price appreciation has all of a sudden stopped? Absolutely not. Just means the blend of homes. Oh, by the way, at the end in December, the median home price in the 5-county area was $200,250. Oh my gosh! I just told you that it went down to $190. Does that mean that home values are dropping in Milwaukee, in the Milwaukee metro area? Absolutely not. It just means the blend of the size and value of homes has diminished in the month of January. January is typically the lowest sales month of any month of the year. Just to give you a comparison, in December, 1,210 homes were sold, and now I just told you 847. So still good, though. I mean, still strong, just as strong as last year. Condos, there were 3 fewer condos that sold. 174 compared to a year ago. Okay, now I want to tell you the story about the guy who's relocating from out of state back to Chicago. I've been working with him for a couple of weeks, and I've been mentioning him from time to time on the show. And so he calls me on Thursday and says, okay, my wife's going to see this house in suburban Chicago on Friday. It's in a very popular suburb. It's not on the market yet, but we got the inside track because we know the real estate agent. It's going to go on the market on Saturday. We think we're going to want to make an offer and prevent it from going on the market. It's listed, Brian, for $679,900. What do you think I should offer? I paused and I said, you want to buy it before it goes on the market, right? Yeah. I'm thinking $679,900. He says, I can't pay full price. I said, dude, if I'm the seller, put yourself in the seller's shoes. If you offer anything less than the full price, why would you not see what it fetches on Saturday?
Right, the following day.
So nonetheless, he offers $670, and he lets me know at the end of the day, Friday, we got the accepted offer at $679,900. Because one of the things I did tell him in our conversation, though, is that if this was in Wisconsin, and I'm not exactly sure how it works in Illinois, but as a licensed Wisconsin broker, if you bring the seller an offer at the full list price with other good terms, by the way, this guy does not have to sell a home, so it's a pretty clean offer, gave him a rock-solid pre-approval, you have earned the commission as the broker, all right? It doesn't actually have to close. If you bring that offer to the seller, oh, you want $679.9, and here's an offer, and the guy's got a pre-approval letter, he doesn't have to sell his house, I've earned my commission, whether you accept that offer or not.
Because you met the expectations.
Exactly. I'm not sure if that's the way it works in Illinois, but I said, if you want to motivate this guy, and he was clued in, my buyer was clued into the fact that this listing agent is motivated because he's going to get both sides of the transaction, right? He's not going to have to split the commission with a buyer's agent. So he's motivated, but you got to give that seller a reason to say yes. And so the takeaway in that story is, it's a seller's market. Jerry, you had a story too.
No question. Well, just kind of to piggyback on that, it is a seller's market. We had a recent buyer who just had closed on a new home. We sent out a survey. He had sent back some notes and comments and highlighted the fact that the pre-approval that we had helped him with, the rock-solid guaranteed pre-approval, was critical in his ability to get that offer accepted, close on his new house, because he was in competition on many houses.
Right.
And once he had gotten that, it separated him from the competition, elevated his offer in the eyes of that seller, wound up getting the offer accepted and closed. And that's just that rock-solid pre-approval. We can't emphasize enough how important it is.
Is it guaranteed, Jerry?
It's guaranteed.
Guaranteed, and if we can't make good on it, we write a check out of $1,000 to both the buyer and the seller.
Right.
And here in southeast Wisconsin, listing agents are really catching on. They get it that ours is better than the flimsy bank pre-approval where they only check the credit.
Next best thing
to a cash offer, baby. All right. When we come back here after the news, what are we going to talk about, Jerry? I forgot.
We've got a couple of things. We're going to surprise.
We're going to surprise you. Okay,
folks.
I like surprises.
All right.
Well, most of the time, not all the time. A lot of the time. WTMJ News Time is 8:30. Time now to check in with the WTMJ Breaking News Center. Once again, Belinda Babinick.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickard on WTMJ.
An abbreviated show today, but a really good show, and you got some surprises here in this final segment, right?
Yes.
Well, yes, I do. All right, one more tidbit on the home buyer that we're helping in Chicago, and this is a great tip for any real estate agents out there, and I've done it a couple of times now. So remember, the purchase price was $679.9, and the buyer really only would like to put 10% down. But we had verified enough assets between his bank accounts and his retirement such that he could make a 15% down payment. So I coached him and I said, if I were you, I would write that offer with a 15% down payment because it looks better to the seller. It's over $100,000, right? And that shows more commitment. It makes you look better. Did a similar thing with another client where she had the wherewithal to put 20% down. That always looks better to a home seller, but we're really going to do 10%. Now, you cannot wiggle out of the contract if I then send you a denial letter that says, "Dear Chicago buyer guy, I can't approve your loan with 10% down." Why? Because you obligated yourself in the contract to go for 15% down. So if you're going to try to wiggle out based on a loan denial, it has to match the terms of the contract.
So importantly, he needed to be able and willing to go with the 15% down payment if push came to shove.
Correct. And so we would not have done that had we not verified that he had sufficient assets. So we're still, honest to God, telling the truth, and still the chief honesty officer and all that. But there is nothing wrong with putting less down payment than what you have indicated in your contract. So a very critical element that you get when you're working with Accunet is that kind of financial savvy and acumen and helping and working with buyer's agents to help you present your buyer in the best possible light. Conversely, we've got somebody where they don't have the down payment. They've only got 3% down, and even though we're rock solid, they're having trouble getting an accepted offer just because of the bias that sellers have towards bigger down payments, even though we're rock solid. And this buyer's agent is a big fan of Accunet, totally understands and totally pitches the value. Mm-hmm. But it's sometimes hard to overcome biases.
But to your point, yeah, that's the strategy of that down payment and being able to show. Okay, yeah, I do want to touch on this because
it's all time to go.
Oh. Right.
Got no time.
Well,
next
going
week.
To be something we can save for next week.
Yeah, we're going to have to. That's a cliffhanger, as they call it. So
next week.
Take away from the shows, mortgage rates are up, not catastrophically, but definitely moving in the wrong direction. And so if you've been sitting there thinking, gosh, maybe I should refinance my home equity line of credit. Maybe I should shorten my loan term. I don't think I'd wait any longer.
No.
Also, though, critical to get going on your rock-solid, guaranteed, fully verified pre-approval to buy because it is a tight.
Buying season started early.
Yeah, it started early, and it's a tight market.
And I love your theme song. And we've got to say goodbye to join Buckshots on WTMJ. Enjoy the basketball game. Have a great Super Bowl Sunday, everybody.